All right, guys. We're just gonna work on this problem. Even when we are looking at this recording, it may be a little weird to you, but it's basically because I will have to look at the problem while showing you some red clicks, some data tables. So this is what we got. I still prefer, for you to struggle a little bit before you really turn in anything or before I tell you what to do. I think this is the best way to learn. I'm gonna download this file, basically, which is here. I mean, the problem with this is I have been trying to do this a few times, but for some reason my browser always freezes. So I have double checked with another problem that all of my calculations are pretty much correct. I build a model and then I just put in the inputs. So I'm just going to go through the calculation using the blank model here, and then I'm going to put in the NPV and IRR. And I have also calculated the data table under different scenarios, different sales price deviating from base case, so on and so forth. So, and then we're going to see it's frozen again. So but let's just build it from the beginning, and then we try to update the assumptions if we need to. Okay. Okay, so this is the Excel model. I hope everything will work fine this time, but it really depends on the website. So we begin with the unit sales. The unit sales is always 900 units. We always have that. We copy and paste. The sales price per unit is going to begin with 27,500. The variable cost per unit is going to begin with 20,000, right? The non-variable cost is going to begin with 1 million. All three numbers are supposed to grow at inflation, so times 1 plus the 4% inflation, right? And then I need to put dollar signs in front of CN11 so that I always refer to this cell. I copy and paste. I got the future price after inflation. I can copy the 3 and put them here. I'm basically inflating the variable cost now. And then I can copy these 3 and put them here. I'm basically inflating the non-variable cost now, right? So if you don't like doing this, you can do it one by one. You can copy this and put it down here. As you can see, it is using the year 1 variable cost times 1 plus 4%. You can copy this and put it down here. As you can see, it's non-variable cost times 1 plus 4%. I just need to keep going. I get more and more. Times 1 plus 4%. And the sales revenue will be the unit multiplied with the price per unit. Multiply them together. And this is here just for us to calculate the working capital. So it's going to be equal to the next period's working capital multiplied with the requirement, 13%. It's right here. I copy that over. So something is wrong. I forgot to put dollar signs for the 13%. So let's do it again. So now, as you can see, in the last year it's a 0, but in previous years it's all depending on the next year's sales. And then we have a base for depreciation, which is the $11 million. And then the depreciation is going to be depending on the base multiplied with the 20%. Oops. Yeah, multiply with 20%. I copy and paste. I have all the depreciation numbers, always the rate multiplied with the base. And then I can have an ending book value, which is the base for depreciation minus the first year depreciation. We have the first year ending book value. The next year is going to be the first year ending book value minus the second year depreciation, so on and so forth. We have a ending book value of $1.9 million. And then the market value for equipment is going to be our salvage value at the end of year 4, right? And then we are making a loss, right? It's going to be the salvage value minus the ending book value, right? We record a loss. If we record a loss, it means we write off some taxes. So how much tax do we write off? We write off this number times the tax rate, right? So the profit and loss times the tax rate is going to be the tax you write off. However, if you are the next step is to calculate the net cash flow due to sale of equipment, you should not use this minus the negative tax, which is plus the tax saving. You shouldn't do that. Why is that? Because 1.2 million, this number, is a hypothetical number. This $1.9 million of book value is just the hypothetical cost base. It is not a cash flow. So the actual cash flow will be the salvage value you make, you collect, you sell it, right? You collect 700,000, and then you have a tax saving, which is 300,000. So you only use the 700,000 minus the tax you pay. If the tax number is negative, it means you didn't pay tax, but you saved tax. So it should be this number, 1.1,200,000. Okay. All right, then it's the cash flow forecast. We're going to say the sales revenue is going to be the sales revenue. The variable cost is going to be the units multiplied with the variable cost per unit. The non-variable cost is just going to be the non-variable cost. The depreciation is going to be the depreciation, right? So everything is pretty straightforward. And then the operating income before tax is the revenue minus the total of the operating expenses, right? And then we pay a tax. It's going to be 25%, right? Tax rate, dollar signs, multiplied with the tax on operating income, right? So that's the tax. And then the after tax is going to be the difference between the two. Then I want to add back depreciation, which is, the depreciation number up here. I already have that. Okay, so these are almost everything. Okay, I can just copy and paste. So everything is filled up, right? So just to double check, this is correct, 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 and this is also correct, right? Okay, so that's the operating profit after tax and then depreciation. And then we can have a equipment purchase. So the equipment purchase is going to be the negative of the actual cost of the equipment, right? We spent this money. And then we will have a change in net operating working capital. So if net operating working capital increased, let's say here, from 0, it increased all the way to 3 million, then it's a negative cash flow, right? You spent money on net working capital increase. So it's going to be a negative of the change. So this minus the previous number. It's a blank number. It's a 0. So let's just leave it as is. So as you can see, it's a huge negative number. But in the last year, it's a large positive number. So you have $3.6 million. And then the net cash flow due to the sale of equipment is just this number, right? So here, after we do this, we are essentially labeling cash inflows as positive, cash outflows as negative. So as a result, all we have to do here is we just have to sum everything. So we don't have to worry about plussing or minusing, different sales. We just have to sum everything. We have all the cash flows. That's pretty much a majority of the problem. And then we can calculate the NPV of the cash flows. So it's going to be equal to NPV of, again, the rate, which is WACC 12%. And then the values are going to be year 1 through 4 cash flows. But lastly, we add back the year 0 negative cash flow. We got 39,96075, and IRR. It's just going to be the IRR formula, and you select all the cash flows. It's a normal cash flow, one negative, a bunch of positives, so IRR should be calculated with no problem, 28%, right? So then I can actually check my answers. As you can see here, I put 39,96075 is correct. I just did that, but it is frozen again, so I don't know what to do. But let's try to restart. If the assumptions are changing, I'm just gonna copy the new assumption into the current Excel file so that the numbers will automatically update. But if the assumptions are not changing, then there won't be any problem. Right, so let's look at these. I think they are the same, right? Let me copy that. Right, they're the same, so it's good. So still this about $4 million, I put it here. 23, 28, I put it here. And then I can check my work. As you can see, both are correct. So that's the basics of that's pretty much the model. The model is correct, then every other calculation should be correct. Okay. All right, and then it's gonna be the regular payback period, years, right? So we just need to first calculate the cumulative cash flow. So the net cash flow is gonna be the same as the previous net cash flow. The cumulative cash flow, there are many ways you can do it. The way I like doing it, because I don't really want to have different formulae across these cells, so I want to use a sum function. In the first one, for year 0, it's going to be sum with itself, right? It's going to be something like this. And then if I put a dollar sign in the first reference, that's the beginning reference of the array, then that's what we fixed, right? So if I copy this, as you can see, the number is changing because from cell 1, I'm only adding the first cell. In cell 2, in the second cell, in year 1 cash flow, I'm adding the first 2 cells as the sum function is expanding, right? We can do that. Okay. To calculate the payback, so for example, the way we can do it, we can say, so for us to calculate the payback period, what we will need to do here is saying, like, you want to calculate the part of year required for payback, right? So what percentage of this year is required for payback? 100% of the year. Right? What percentage of this is required for payback? I mean 100%. But what percentage of this year is required for payback, right? But apparently not 100% because you will have collected everything during this year because this is not negative number anymore. So what percentage of that? It's apparently gonna be this minus this divided by this, right? It's gonna be something like this, right? So you can calculate it. You can calculate a payback like this. So it's gonna be the sum of these 3 numbers, 2.84. So if I put it in here, 2.84, and let's check the answer. As you can see, it's correct, right? The more comprehensive way to do it is to use an if statement. That is to say, equals to if this is negative, it means you haven't paid back, so it's a 1. Otherwise, right? Otherwise, it's gonna be whatever we put in year 3 number, right? So this minus this divided by this, right? So it's a 1.84, right? So the problem arises when in the last year, as you can see, it's a negative number, right? You can use a separate if statement to incorporate that. If that's a negative number, then it's a 0. You can say that, right? So you can say if this is smaller than this, right? So we can have another if in here, right? If this is smaller than this, in other words, your current cash flow is smaller than the cumulative cash flow, then it's a 0. Otherwise, it's this number. As you can see, it's going to be a 0. If I copy it over, it stays the same. What's the benefit of doing that? It's like you don't have to change the structure of the model. You can just select everything and add them together. It's still 2.84. Okay. All right. I just have to say these are all pretty dumb. The way I like to do it is to use the percent rank formula, which is what is introduced in the book. Okay. So percent rank formula. So you need to enter an array. Array is the cumulative cash flow. You want to look for 0. in this array, where does 0 locate in this array? And then significance. Significance is basically how precise you want it to be. Let's say 6. It's like 6 after the decimal place. Okay. And then because this is a percentage of a total of 4 years, I just need to multiply by 4. 2.84. It's always 2.84. So either one of the 3 ways it can work. Okay. So that's basically the first 3 cells, and then I'm going to try to work on these. So that requires some data table analysis. So how do we do data table? So we first need to link this cell to the NPV formula in the model, and then we need to populate these. Okay, so these are just like minus 20% away from the base case. So how do I do it? It's going to be the base case multiplied with 1 plus the 20%, negative 20%, right? So we can do that. And then I can copy and paste. I'm gonna do special paste the special, because as you can see, there are those little lines, borders that are also pasted. I don't want that. I just paste formulas and number formatting. Okay, so then it's gonna be the numbers. And then how do I populate the how do I populate these? I have to first select everything, then go to data, what if analysis, data table, right? And then I'm asked to put in a row input cell or column input cell, because this thing is a column, right? So it's gonna be a column input cell. Okay. So the column input cell is gonna be the input cell. It's gonna be an input in the model. In this specific case, it's a sales price per unit. Right, so I hit enter. I got all the values. As you can see here, this is the base case, the same number here. Okay. Okay, so I can keep going. For example, for the second one, I can first populate these by copying this and paste it here. They're going to be wrong because I have dollar signs for the first one. So all I need to do is to drag it over. So I can refer to the first cell here rather than the first cell up there. And then I do the same thing. I drag it. As you can see, the line is copied as well. I don't like that. I'm just going to copy, paste, special, and just the formula and the number formatting. And this is the same thing equals to B48. This is the same thing equals to B48. I'm just going to do that. And then this is going to be the same thing. Once again, I'm just going to copy this and put it here. Drag it over. Sorry. This should also be dragged. I copied it wrong, but it worked. And then I copy this, I paste here, and then formatting. Okay, I got these numbers filled in. I'm curious, what if I do this? What if so C8, apparently C8 is the reference. Now I'm gonna go to C9, right? What if I copy this and put it here? Does it work? It doesn't, right? So basically you cannot really do it. You just have to do it again. So you can do what if analysis, data table, column input cell is gonna be C9, right? So sorry, no, C9, yes, variable cost per unit, right? So I hit enter, I got everything again, base case, they're the same. And I do it again, data selection, data table, what if analysis, column input cell is gonna be the $900 units, C7. Hit enter, I have everything populated, they're here. Right? So as you can see, they're here. So this is the sensitivity table. When this is changing, how about these, right? So I can plot these. So basically I can do this, I can insert, I think a line graph should be fine like this, right? So there we go. Okay, so this horizontal line is the 20, 10, 0, and 10, 20. I can delete that, and I have these, right? And then I can, make it look better, I can edit the horizontal axis. The axis label is, the axis label will be these values, right? As you can see, the axes have already updated. And the series can be, for example, the first one, the series name is going to be sales price. For the second one, the sales name is going to be variable cost per unit. For the third one, it's going to be number of units sold. Okay, I hit OK. As you can see, I have the chart. That's ready. Okay. I can make it a little bigger. Maybe I can put it here and make it as big as this, just to make it look a little better. I can delete the chart title. I have the table. I have the graph. Okay. And then now I have the scenario manager to work on. Oh, before I do that, let's just copy this number and check if it's correct. As you can see, it's correct. Another one, put it in. Ah, it's dead again, but you know, I suppose it's gonna be correct this time, right? Okay, and then I can use the scenario manager to calculate this, the base case, best case, base case, and worst case, you know, things like that. Apparently the cases are already here, right? I just need to go to data, what if analysis, and create the 3 scenarios. Okay, and then let's say here, so the important ones are these 3. So I go to data, what if analysis, scenario manager. I can add a scenario. Let's say it's the base. Let's say it's the base case, and I'm gonna change these 3 cells, and they say okay, 900, 27,500, and 220,000. That's the base case, and then I can have a best case. So what is the best case? I actually forgot, but you know, don't worry. Let's add another one. Let's say the worst, and say okay. Right? For now, the 3 scenarios are exactly the same because I forgot the numbers. I just have to scroll down here so that I can see the numbers and then see what if analysis, scenario manager. I have the scenarios. So the best scenario, I can edit it by changing these cells. I say, oh, my bad. So I just need to remember these names. 1080, 33,000, and 1600. Right? So scenario manager, the best case, I want to edit it. Hey, okay. All right. So it's going to be 1080, 33,000, and 16000, right? So that's the 3 scenarios. The worst case scenario, I just want to edit it and say okay. And then the worst case is going to be 720, 22000, and 24000. Okay, so that's the 3 scenarios. It's ready, and I can say, how about let's see the base case scenario and show. So what do I get? The NPV I got is the number I just got. I'm gonna just paste it here, and I'm gonna paste just value and the number format. Okay, that's all it is. And then I can go back to scenario manager and to show the best case. As you can see, in the best case, this graph also changed a little bit, but the best case is 31 million. Do the same thing, paste it here and here. Okay, and do it again, scenario manager, worst case, and show. Okay, so as you can see, it's negative 15 million. I can put it here, and also it's just a number. All right. I can go back to the scenario manager and show the base case scenario. I can show. Yeah, it's fine. So I can show it. Ah, it's back. Okay. All right. So that's the 3 NPVs. I can calculate the expectation, which is apparently pretty simple. You may want to use this multiplied with this plus this multiplied with this plus this multiplied with this. It's fine. You can also use a formula called sum product, and you can select 1 array and 2 arrays. So what it does, it's gonna multiply the first with the first, second with the second, third with the third, then add them all together. As you can see, the number is the same. Okay, so that's the expected NPV in this specific example. All right, so once you have the expected NPV, you just have to be able to calculate standard deviation under the distribution. So what you will need to do is that you will have to use the probability multiplied with the squared deviation. So that is the, for example, this NPV minus the mean squared plus the second probability multiplied with this NPV minus the mean, and then squared, and plus, okay, the probability multiplied with this NPV minus the mean squared. Okay, so that's the variance, and then you have to take the square root of the whole thing. I have to do that. Okay, and then coefficient of variation is just standard deviation over the expected NPV. Okay, that's pretty much it. Okay, so yeah, so that's the most of the calculation, and then it's gonna be the if the project appears to be more or less risky than the average project, finding its risk-adjusted NPV, IR, and the payback, right? So, well, you just need to use the correct WACC in this calculation, right? So, for example, the average risk project should use 12%, but the average risk project will have a coefficient of variation between 0.8 to 1.2. But our coefficient variation is way beyond that. So you just have to, which one should you use, right? Does this mean it's more risky than average risk project, or it's less risky than average risk project? And then after you know that, all you need to do is to replace this, like make this maybe 14% or 9%, depending on what you believe. And then you put whatever you got in the model in here. Okay, that's all it is. I hope that's clear, and I hope that's helpful. If there's any questions, let me know. Thank you very much.